We shall commence this module by understanding the national income. National income is the sum of a country's final output of all new final goods and services produced in 1 year by the productive system of an economy. After studying this module, you'd be able to know the meaning of national income, know the different factors affecting national income, analyze the methodology to calculate national income, know the uses and limitations of national income statistics, evaluate the relationship between GNP and the standard of living of a nation. Let us discuss the factors affecting national income. The first is resource allocation. This is based on the physical capacity of factors of production and the given technology. The more efficient and effective factors of production lead to better national income as the total productivity of the nation increases. Hence, every nation strives to get better factors of production. First, land resources. The geographical location of the natural resources also affects the level of national income. That is, the areas rich in coal, iron and other such essential items affect the level of GNP of the nation. Second is labor. The quality of human resource affects the standard of a nation. The productivity of labor is more important than quantity. Third, capital. Capital is generally determined by investment, which in turn depends on other factors like profitability, political stability, etc. Fourth is technology. In addition to natural resources and labor, the level of invention and innovation in production affects the productivity of the factors of production. Thus, the per capita output grows with the help of technology. The second one is government. Government is the key resource to provide a favorable business environment and hence it affects the productivity of the nation and in turn affect the national income of an economy. Although classicals believe that the government is an impediment to growth in output. The third factor is political stability. The political system of a nation affects the stability of an economy. A stable economy in turn increases the productivity and the national income of a nation. Unfavorable business environment encourages the problems like wars, strikes and other social unrest which discourages the economic development of a nation. Moving on to understand the national income accounting. A. GDP, that is gross domestic product. GDP is the total value of goods and services produced within the country during a year. This is calculated at the market price and is known as GDP at market price. There are three methods to calculate GDP at market price. First is the income method. Under this method, all incomes received by the factors of production generated in the economy during a year are added together. It includes payment for wages on both employment and self-employment, profits, interest to lenders on capital or rents to the owners of land. The second is the output method or product method. Under this method, the combined amount of new and final output produced in different sectors of the economy, including manufacturing, financial services, transport, leisure and agriculture, is taken into account. Third is the expenditure method. Under this method, all spending of the economy by household and firms on new and final goods and services by households and firms are added together to calculate the national income of an economy. National income aggregates. Value of gross output is equals to price into quantity of all goods and services produced in the country not adjusted for bought out inputs. Since prices differ, therefore, gross output is equals to summation Pi into Qi, where I goes from 1 to n. Net output is equals to gross output minus value of bought out inputs like value of raw materials purchased. Net output is equals to gross output. Therefore, net national output is equals to gross national product. If GNP is adjusted for income earned from abroad, then GNP minus net income earned from abroad is equals to gross domestic product measured at market prices, which is also equals to GDP at MP. B. Gross domestic product at factor cost, that is GDP at FC. GDP at factor cost is the net value added by all producers within the country. GDP at factor cost is equals to GDP at MP minus indirect taxes plus subsidies, which is equals to GDP at FC. C. Net domestic product, that is NDP. NDP is the new output of the nation during the year. Capital assets wears out or becomes obsolete each year during the production process. Thus, net domestic product is equals to GDP at factor cost minus depreciation, which is equals to NDP at FC. D. Nominal and real GDP. When GDP calculated on current prices, it is called as GDP at current prices or nominal GDP. While when GDP is calculated on the basis of fixed prices in some previous year, then it is known as GDP at constant prices or real GDP. It measures the value of goods and services by ignoring the changes in the price level. To find out the real GDP, a base year is chosen when the general price level is normal, that is, it is neither too high nor too low. The prices are adjusted on 100 or 1 in the base year. Thus, real GDP at the base year prices is equals to GDP for the current year into base year index, which is equals to 100, divided by current year index. Suppose 2000-2001 is the base year and GDP for 2014 and 15 is rupees 6 lakh crores and the price index for this year is 300. Thus, real GDP for 2001-2 is equals to rupees 6 lakh into 100 divided by 300, which is equals to rupees 2 lakh crores. Thus, real GDP at constant prices is equals to GDP at current prices divided by GDP deflator. E. GDP deflator. GDP deflator is a barometer of price changes of goods and services included in GDP. It is the price index which is calculated as follows. GDP deflator is equals to nominal GDP on current prices divided by real GDP or constant prices into 100. F. Gross national product, that is GNP. GNP is the total difference in the flow of goods and services at market value resulting from current year's production of a country. It also includes the net income from abroad. GNP includes the following final goods and services. First, consumers' goods and services which satisfies the wants and demand of people. Second, gross investment in capital goods consisting of total capital formation, household construction and inventories of finished and unfinished goods. Third, goods and services manufactured by the government and its organizations. Fourth, net exports of goods and services, that is, the difference between the value of exports and the value of imports of goods and services known as net income from abroad. Next, we shall discuss the national income estimation. There is a difference between national income accounting and national income estimation. National income accounting tells us how to derive one national income aggregate from the other. National income estimation tells us how to calculate national income. But we do not use the term calculation because very often the enumerators who calculate the national income have to use methods of estimations or even guess estimates for assessing the production or income generated during 1 year. Precautions in national income estimation. The factors to be taken into consideration while estimating national income are: first, money value considered. GNP is the sum of money in which all kinds of goods and services manufactured in a country during 1 year are measured in terms of money at current prices and then added together. But in this manner, due to the fluctuations in the prices, the GNP is increased or declined, which may not be real. To guard against erring on this account, a particular year, that is base year, when prices are normal is taken and the GNP is adjusted in accordance with the index number for that year. Second, avoid double counting. In estimating GNP, the market price of only the final products should be considered. Many of the products pass through different number of stages before they are ultimately purchased by the consumers. If these products are counted and calculated at every stage, they would be included many a time in the national product. Consequently, the GNP would increase too much. In order to avoid double counting, therefore, only the final products and not the intermediary goods should be taken into account. Third, avoid non-market value. Goods and services given free of cost are not included in the GNP because it is not difficult to have a correct estimation of their market value or price. For example, the bringing up of a child by the mother, giving instruction to his son by a teacher, recitals to his friends by a musician, etc. Fourth, the transactions which do not arise in the current year or which do not contribute in any way to production are not included in the GNP. The sale and purchase of second-hand goods and shares, bonds and assets of existing companies are not included in GNP because these do not make any addition to the national product and the goods are simply transferred. Fifth, the payments received under Social Security, for example, unemployment insurance allowance, old age pension and interest on public loans are also not included in GNP because the recipients do not provide any service in lieu of them. But the depreciation on machinery and other capital goods is not deducted from GNP. Sixth, the profits earned or losses incurred due to the fluctuations in market prices in the value of capital assets are not included in GNP if they are not responsible for the current production or economic activity. For example, if the price of a building or of a bare land increases due to inflation, the profit earned by selling it will not be a part of GNP. But if during the current year a portion of a house is constructed anew, the increase in the value of house after subtracting the cost of the newly constructed portion will be adjusted in the GNP. Similarly, variations in the value of assets that can be ascertained beforehand and are insured against flood or fire are not included in the GNP. Seventh, the income earned in restricted activities are not to be included in GNP. Though the goods sold in the black market are priced and fulfill the needs of the people, but as they are not useful from the social point of view, the income received from their sale and purchase is always excluded from the GNP. G. GNP at market prices. To convert gross domestic product into national product, we must add the total income from abroad into a nation. GNP at market prices is equals to GDP at market prices plus net income from abroad. H. GNP at factor cost. GNP at factor cost is the sum of the money value of the income produced by and accruing to the various factors of production in 1 year in a country. GNP at factor cost is equals to GNP at market prices minus indirect taxes plus subsidies. I. Net national product, that is NNP. NNP is the sum total of outputs on consumption goods and investment goods. But this process of production uses certain amount of fixed capital and the fixed equipment wears out with time, or other components are damaged or destroyed, and still others are rendered obsolete through technological changes. Therefore, NNP is equals to GNP minus depreciation. J. NNP at market price. Net national product at market price is the sum total of final goods and services evaluated at market price in a country. Value of final goods and services evaluated at market prices in a country. NNP at market price is equals to GNP at market prices minus depreciation. K. NNP at factor cost. Net national product at factor cost is the total output evaluated at factor prices. It includes income earned by factors of production through participation in the production process, such as wages and salaries, rents, profits, etc. It is also called national income. NNP at factor cost or national income is equals to NNP at market prices minus indirect taxes plus subsidies. Let us now discuss the uses of national income statistics. First, standard of living. One can easily compare the standard of living of different nations with the help of their GNP. Hence, national income statistics can be used for analyzing the standard of living of a nation. Second, policy formulation. The national income statistics are used to compile the GNP statistics of the economy. The government then uses this data for policy formulation. Third, international comparison. The standard of living of different nations can be compared with national income statistics, which in turn helps to show the rate of growth or development of different nations. Fourth, business decisions. The level of development of different industries and sectors respectively of an economy is analyzed with the national income statistics. It in turn helps the business to plan for production and planning. We shall now move on to discuss the limitations of national income statistics. GNP is used to measure the overall flow of goods and services and also to show the general welfare of the people. It aims to get the standard of living of a nation. There are certain limitations of GNP statistics which are as follows. First, price changes. A high GNP may not necessarily mean that the standard of living of a nation is also good. With an increase in GNP at a high rate, real GNP may even fall. Second, omission or wrong estimation. It may happen that the national income statistics be affected by wrong estimation like that of double counting, etc., due to which it may mislead the other supplementary statistics too. Third, voluntary services. Some voluntary services also have an influence on the national income, but the statistics may or may not accommodate them. Fourth, illegal activities. Some illegal activities are always prevalent in an economy, but national income statistics ignore the income and productivity generated from such activities. Illegal activities may affect the actual standard of living of an economy. Fifth, undesirable effects of production. Factors like pollution, traffic congestion, do have an influence on the standard of living of the economy. This is again not taken into account for national income statistics. Sixth, problem of comparison. National income statistics are a bit difficult to compare as the method adopted by different nations are different. To bring in complete similarity in the methodology is a difficult task. 7th, output composition. Nations having the same GNP may even have different living standard because their output composition may be different. 8th, distribution of national income and wealth. The GNP of a nation may be generated by a small group or rate of people in a nation. So, in that case, even with a high national income, the standard of living of the nation will be low as it is not evenly distributed income or GNP. 9th, population size. The population level of a nation does not hold any significance with the standard of living. So, the per capita income is a better measure to compare the growth of two nations. 10th, national defense. If a nation has spent a lot of resources in the production on national defense, like in weapons and so on, then its living standard may not be improved. 11th is time. Technology is improved and improvised with time, but these statistics do not depict these parameters and hence are not the true indicators of the standard of living of a nation. Now, we will summarize what we have learned in this module. To summarize this paper, we have understood the meaning of national income or GNP. We have also studied the procedure to compute national income of a nation, which can be computed through their methods, namely income method, expenditure method and output method. Different economies use different procedures to calculate their national income. The national income over a period of time creates a statistics which is used for economic evaluation. It also has certain limitations which have been thoroughly covered in this paper.